All right. Hi, everybody. Welcome to WGS2D's very first video presentation. Paul and I are really excited to walk you through today's presentation on the 2025 Federal Reserve Bank's annual stress test exercise. We'd love to get your comments on social media. And if you're watching this on YouTube, please hit the like button and subscribe to our channel to get notifications of new content. With that, let's get started.
All right, thanks, Charles, and thanks everyone for joining. Here's the agenda for our presentation today. As Charles mentioned, the purpose is to provide some background for the annual stress testing exercise in the U.S., and then we'll review the 2025 stress test results. Our intended audience is mid to upper management bank executives, but we've also provided just some background material on the stress testing program as a whole for those that are either new to the banking industry or new to stress testing. Including some of the key metrics used in the industry and macro variables that are used in the exercise. The second section is where we'll review the results of the 2025 stress test.
Yeah, before moving on, though, we do need to mention that the information presented in this video is for informational purposes only, and it's not meant to be legal, regulatory, or professional advice. If you're looking for professional advice or counsel, feel free to reach out to Paul or me, and we'd be happy to point you in the right direction for your specific circumstances.
And just one more thing before we get started on this year's exercise, we wanted to just introduce WGS2D Consulting. We started this consulting firm because we as partners believe that consulting can be a better experience for our clients. We work with you to define the scope. There's no out-of-box solutions here. There's no trying to sell you on a set of campaigns and solutions that have been shopped around to other firms. We work with you directly based on our combined 150 years of experience in consulting and working with financial services firms. Once we're aligned on where we want to go, we won't bog you down in the contracting process. We aim to be very easy to work with.
Yeah, in the spirit of aligning our interests with our clients, we're also willing to commit to delivering on outcomes. And if we don't deliver, our clients don't pay us. We're also open to non-traditional contracting frameworks, including value-based deals. That said, we're not necessarily the right partner for everyone. We're intentionally focused on financial services, given our backgrounds, and our capabilities are in 5 areas: risk, compliance, and regulation, data and cybersecurity, tech consulting, strategic cost reduction, and process efficiencies, and then finally, sales effectiveness.
And then finally, just a little bit about your 2 speakers today. I'm Paul, former senior regulator in the Federal Reserve System, where for a number of years I helped to develop and run the earliest CCAR and DFAST exercises. Since leaving the Fed, I've been advising banks across a variety of areas to make sure that they're complying with enhanced prudential standards and Regulation YY, developing fit-for-purpose stress testing programs, and helping out with a number of different challenges in the non-financial risk space. So good to be with you today.
And I'm Charles. I've been a consultant for over 20 years. And I've been working with banks to develop their internal stress testing programs and to remediate their regulatory findings. Today, we're diving into the results of the 2025 stress test with a lens on what it means for different business models and risk categories. All right, so this is a little timeline of US regulatory stress tests. Anyone in banking or consulting over the last, say, 17 or 18 years remembers 2008. The housing market was overheating with Alt-A loans and minimal income verification, leading to widespread mortgage fraud. By 2007, so before 2008, the credit markets were already unstable. I recall there was an MD at JP Morgan. He was trying to tell me and a group of newly minted IB associates that the slowdown in the CDO market was temporary. He was trying to recruit us for his team, basically. Well, he couldn't have been more wrong, as we know now. Bear Stearns collapsed in 2008, and it was the start of a chain reaction. And although JP Morgan acquired them, I lost my associate role when the two associate classes were consolidated between the two companies. This pushed me back into consulting, where I focused on energy bankruptcies and restructuring. After Lehman's collapse, the government intervened with TARP to prevent total financial collapse, but the backlash led to the Dodd-Frank Act, which mandated supervisory stress tests. By 2012, the banks had to submit their first stress test results, and I joined Accenture just maybe a few months before that started in earnest. My first project in stress testing was at the start of this process, but by 2019, the increased size thresholds for Category 4 firms, which moved from 10 billion to 100 billion in assets, made stress test projects really hard to come by. Paul, your experience during this time frame is also quite interesting given your time at the Fed. What do you remember about the events leading up to Dodd-Frank and thereafter?
Yeah, so my focus as a regulator, sort of pre-crisis, was on credit and structured credit. So I did a lot of work around, looking at banking book assets, but also looking at some of the traded credit products. So, CDOs and other synthetic products related to traded credit. So that was occupying a lot of time for the regulators. But I think the biggest eye opener for me was prior to 2012, which was the first sort of formal CCAR exercise. We did an exercise in 2009 that was called the SCAP exercise, the Supervisory Capital Analysis Program. And that was a much more open-ended exercise than sort of the structure that was around CCAR. We provided some high-level macro variables, but asked firms to provide us some insight into how they would fare under the economic conditions specified by those variables. And our understanding of the sort of internal capital adequacy processes for a lot of firms was shaped around concepts like economic capital, which was a more, I'd say, parametric approach to relating risk levels to the required level of capital. And I think to a bank, the 18 banks that were involved in that exercise, none of them referenced their economic capital frameworks for how they thought about how the balance sheet and the income statement would evolve under periods of stress of the sort that we specified in the exercise. So, that realization, I think, changed pretty drastically the perspective of the regulators on how to ultimately structure the CCAR exercise and how to encourage banks to develop models, governance, and infrastructure to think about more directly the impact on the income statement and the balance sheet from the types of scenarios that would be included in subsequent exercises, and the types of scenarios that would really be an extension of the financial planning and analysis programs that many firms had stood up. So getting into a little bit more on sort of the mechanics of the stress testing exercise. There are risk categories of banks that were defined by the 2018 tailoring rule that are really foundational to how the Fed determines the scope of stress testing and the application of other prudential requirements. You can think about this as each step down in category corresponds to a more tailored and proportionate regulatory set of expectations.
Category 1 includes GSIBs, and they undergo the most rigorous standards, as you would expect. They have annual supervisory stress tests, internal capital planning assessments, liquidity stress tests, and the enhanced LCR and NSFR requirements.
After category 2, you have after category 1, rather, you have category 2 and 3 banks. While not the globally systemically important banks, they're still subject to annual stress testing exercise and the stress capital buffer, which is the estimate of the deterioration in capital that comes across through the severely adverse scenario, which we'll talk about here in a little bit. These firms must also run internal stress tests under Regulation YY and submit annual capital plans for review.
Yeah, Capital 4 banks, however, are only required to undergo supervisory stress tests every other year, and they're exempt from mandatory internal capital plan submissions unless triggered by specific circumstances. Their liquidity requirements are also simplified, generally no full LCR, NSFR.
So in practical terms, this means that as you move down the categories, the Fed reviews fewer risk types, reviews them with less frequency, and really does rely more on firm-run processes. So this is not this doesn't mean that there's not still a significant amount of regulatory oversight there. It just means that more of the onus is on the banks themselves, particularly in categories 3 and 4, to ensure that the internal models, the governance structures, and the overall functioning of the risk programs are strong and defensible.
This year's lineup includes 22 banks, the usual 20 that are required under the rules, plus 2 Category 4 banks that volunteer to participate despite not being mandated in this odd-numbered year.
And to that point, normally the Category 4 banks are only required to participate every 2 years, with the odd year, such as 2025, being what they consider off-cycle. But this time, there were 2 firms that opted to voluntarily submit capital plans.
Public findings and investor communication suggest that these volunteered participants had strategic motives. For example, boosting transparency and signaling financial strength to the market. One firm indicated it wanted less stress capital buffer to reflect the updated 2025 results rather than relying on the prior test.
And with the Fed proposing to average results over 2 years, voluntary participation can actually help a bank that only has to submit every other year by helping to reduce volatility in its stress capital buffer. This would help minimize spikes or drops in required capital stemming from an outlier scenario.
All right, well, let's take a moment to walk through the core metrics regulators use to evaluate capital adequacy under stress. These aren't just accounting measures, they're carefully defined regulatory ratios meant to capture a bank's ability to absorb losses while continuing to operate.
And at the top of the table, the most important of these is Common Equity Tier 1 capital ratio, which measures the core capital a bank holds against its risk-weighted assets. CET1, as it's referred to, is the most loss-absorbing form of capital and a key determinant of a bank's post-stress capital buffer. And again, saying it's the most loss-absorbing means it's really composed primarily of additional paid-in capital from any stock issuance, as well as the retained earnings of the firm. As I said, it's also the basis of the stress capital buffer requirement that the Fed imposes each year.
Next is the Tier 1 capital ratio, which includes CET1 plus some other qualifying instruments like non-cumulative preferred stock. This expands the capital base slightly, but it's still focused on high-quality capital.
Next in the table, you have the total capital ratio, which incorporates Tier 2 capital with instruments such as subordinated debt. While it's a broader measure of capital, regulators tend to focus more heavily on CET1 and Tier 1 as measures of going concern resilience.
Then there's the Tier 1 leverage ratio, which doesn't use risk weights in the denominator. It's simply capital divided by average total consolidated assets. It's a blunt but useful tool to capture overall size-based risk.
And then lastly here, for the largest and most complex banks, particularly those with significant off-balance sheet exposure, there's a supplementary leverage ratio, which adds a further constraint. It includes off-balance sheet exposures in the denominator and is especially relevant for institutions that have large derivatives positions or repurchase books. So getting a little bit into the 2025 exercise, the Fed issues 3 different scenarios as part of the stress testing program. A baseline scenario, which is sort of a most likely economic outlook, an adverse scenario, and a severely adverse scenario. The Fed scenarios, each of them, include 4 headline macro variables: real GDP growth, BBB corporate yields, CRE price index, and unemployment. Behind the scenes, there's actually a total of 24 variables that are used to inform the bank models and define the scenarios. Among these, the unemployment rate is most often predicted for consumer portfolios like credit cards, auto loans, and student loans. For commercial real estate portfolios, the CRE price index tends to be more directly correlated with expected loss. And then measures like GDP growth and BBB yields often influence the corporate and investment, corporate industrial loan performance and market risk estimates.
Regulators are looking for macroeconomic predictors that are intuitive with the target variable. So even though They provide you with with 28 variables. They're not necessarily looking you to exhaust all 28. What they're really more focused on is that you're achieving a close model fit, but with intuition built into the forecast. So although the VIX or the Dow Jones Index often help to create the spikiness observed in credit loss rates during historical stress periods, they're often not intuitive and they're difficult to explain to the regulators. Fortunately, if you have a strong stress test governance program at the bank, issues with the inclusion of problematic variables should be addressed before they get to the regulators. It's not that banks shouldn't use these variables, but they need to justify their use incredibly well, both in their model documentation as well as in their narratives. In my experience, regulators are more forgiving if these types of variables only have a secondary or tertiary influence on their predictions.
So now getting into the results of the 2025 exercise. As you can see on this page, the aggregate CET1 ratio for all firms included fell from 13.4% to 11.6% under stress, so a 1.8% decline, which keeps the industry as a whole well above the regulatory minimum. From a supervisory perspective, that's obviously quite reassuring, reflects strong balance sheets and continued capital accumulation and strong earnings performance over the last couple of years in particular. But we still saw notable declines at banks with heavy exposure to credit cards and commercial real estate.
Yeah, that's not a surprise given the stress scenario. It included sharply rising unemployment and a 34% drop in CRE prices. It reflects current market anxieties, particularly around unsecured credit and consumer debt fatigue. BMO had the lowest CET1 buffer under stress among all the banks tested. We suspect that the Bank of the West acquisition probably added balance sheet complexity and large middle market C&I lending book with exposure to cyclical sectors like manufacturing and energy.
And add to that, some of the cross-border banks like BMO face some added complexity. They have to reconcile different accounting standards, different supervisory expectations between home country regulators and what they call host country regulators, like the Federal Reserve, and different asset mixes. This often shows up in stress testing results, particularly for what are deemed to be the foreign banks. And so for banks like this, challenges in tailoring models to U.S. scenarios, leveraging data that's typically looked at as a portfolio as a whole to discriminate for U.S. customers can also be a challenge. On the opposite end, Schwab emerged with the highest post-stress CET1 ratio, which from a regulatory perspective reflects a more conservative risk profile, less reliance on unsecured consumer credit, and more fee-based revenue.
Yeah, that said, that doesn't mean they don't carry risk. I mean, Schwab does carry interest rate risk, particularly from held to maturity securities. But under the Fed's assumptions, that risk didn't really translate into material losses. This slide shifts the focus a little bit from risk-weighted capital metrics like CET1 to leverage-based ratios. Not completely. Obviously, we still have a couple of capital ratios there. But yeah, I mean, Tier 1 leverage and supplementary leverage ratios obviously are featured here on this slide as well. These don't adjust for risk, as we mentioned before. They use total exposures in the denominator, which creates a very different lens on bank capital.
Yeah, and to that point, I think what's interesting here is Charles Schwab's positioning. You'll remember from the review of the CET1 ratios, they had the highest capital buffer among the 22 participating banks. But on the leverage metrics, Schwab is much more in line with peers. That's not a mistake or a surprise necessarily. It really does reflect how the balance sheet is structured and the level of capital relative to the notional size of the balance sheet.
Exactly. Schwab carries a large portfolio of low risk, low yield assets like treasuries and agency MBS. These inflate its total assets and leverage exposure. These don't require much capital under risk-based frameworks, but they still count fully in leverage metrics.
which from a regulatory perspective, really highlights why the Fed looks at both the risk-based measures as well as the leverage-based ratios in stress testing. CET1 will show how much capital there is against the riskiest exposures and sort of the risk tiering of the balance sheet as a whole. But the leverage ratios prevent banks from becoming too large with capital being too disconnected from just the overall sort of notional size of the balance sheet, even if the portfolios themselves are technically low risk in nature.
Yeah, it's also a reminder for banks like Schwab, optimizing capital ratios isn't just about credit risk. Asset composition and funding structure also matter when it comes to leverage regulation. All right, well, I think we alluded to this a little bit earlier in our presentation, but this the story for this year is really around credit card risk. Everybody knows the headlines around rising delinquencies and record balances that have already been flagged in the market. Now, the stress test kind of affirms that concern.
And from a supervisory standpoint, as a matter of sort of ongoing supervision, you can expect that the regulators will continue to focus on strength of the consumer and looking at these consumer portfolios given the results of this exercise. And we'll continue to leverage stress testing as a whole to incorporate more dynamic risk themes into future exercises, particularly around some of the operational risk areas like cybersecurity, climate risk, and potentially even AI-driven operational vulnerabilities.
Yeah, and for banks in categories 3 and 4, stress testing can't be just about compliance. It needs to drive decisions on capital allocation, portfolio strategy, and internal risk appetite. It's an expectation from the regulators, that you incorporate these measures into your BAU. Well, as we mentioned before, this is a little bit of a deeper dive into different product types. And as mentioned, or maybe alluded to before, Capital One stood out this year. Its projected credit card losses were not only the largest in dollar terms, but also among the highest in terms of loss rates.
Yeah, and as a regulator, I think this was maybe not a huge surprise, just given sort of Capital One's business model. But going forward, you'd expect that there'd be a fair amount of focus on Capital One's performance in the context of some of the modeled assumptions that went into this year's stress test, as well as credit quality really at the segment level and how those portfolios are being actively managed. Their customer base and risk appetite make them more sensitive to shocks in consumer spending and unemployment. And if you contrast sort of their results to the big three, JP Morgan, Bank of America, and Wells Fargo, all maintained very strong capital buffers, but did continue to see vulnerabilities in segments like CRE and credit cards.
Wells Fargo in particular showed improvements in capital under stress year over year, which may reflect de-risking in its commercial portfolios. All right, well, we've come pretty much to the end of our presentation today. Just some concluding thoughts. As we mentioned earlier, banks demonstrated some broad capital resilience this year. Nobody failed the quantitative exam. Everybody's well over the capital ratios on all measures. We saw that consumer credit, especially credit cards, emerge as the highest loss category. And then we saw some specific outcomes relating to individual banks that reflect, certain strategic exposures like Capital One, obviously high consumer risk. But some of that's offset by scale and analytics. You have Schwab, very strong CET1 ratio. But I mean, the results are still really solid, even when you take away the denominator effects using the leverage metrics. Still strong. They just have a low risk balance sheet. And then you've got BMO with thinner buffers, and we think that has something to do with some of the portfolio shifts that occurred as a result of the acquisition of the Bank of the West. Risk-based measures versus leverage-based capital measures, they tell slightly divergent stories, as we mentioned earlier. We had a couple of category 4 banks that volunteered this year, and they did it for strategic reasons. Stress testing remains a key tool, but it's not just for compliance purposes, but also for strategic capital planning. And then, as Paul mentioned earlier, looking ahead, we expect stress scenarios to continue to evolve with potential inclusion of other operational type risks like cyber, climate, and geopolitical shocks.
Yeah, and on the tail end, obviously, of the release of the quantitative results, firms also receive feedback on their internal stress testing processes. So if you are a bank executive concerned with those regulatory findings this year and would like a third-party perspective, we'd be happy to meet with you and offer that perspective. In fact, we'd be willing to meet with you in your current look at your current remediation plan, provide feedback on that, address any gaps, make recommendations, all of that pro bono. Similarly, several executives watching this video might work for banks that are transitioning from one category to the next and looking to meet all of the requirements associated with that transition. We'd be happy to discuss your current project plans to achieve compliance, validate identified dependencies, and make recommendations. Again, all on our dime. Let us know if you're interested in either service by sending us an email. We'll provide those at the end of this presentation and would very much like to speak with you. So here we are. Here's our contact information. Thanks so much for watching. We hope this review helps you understand not just the what, but also the why behind the stress testing results.
Yeah, as Paul mentioned on the previous slide, feel free to reach out to us. Our contact information is here on the slide, and we'd love to hear from you. Thank you for joining us today for this presentation.
Thanks so much.